Okay, so we're group 4, and we're going to start out talking about the fortified forces. The first one of the forces we're going to talk about is substitutes. As we mentioned in our first video, Comcast has a very high risk due to streaming services that can provide similar content to cable, but at a much cheaper rate. Johnson & Johnson, on the other hand, have a really low risk when it comes to substitutes. Substitutes for them would be things like natural herbs or remedies. They also provide a different approach to treating medical concerns, and they're a lot cheaper. But however, it's still low risk because the natural remedies don't have like a high of success rate as actual companies like Johnson & Johnson. And usually the concerns that people have that lead them to buying Johnson & Johnson products are usually things they wouldn't put in the risk, put with risks of natural remedies. But people may choose natural remedies because it feels more personal in a sense. So Johnson & Johnson can lessen this risk by being more service-oriented. The second force I'm going to mention is competition. As we mentioned in our earlier presentation, Comcast has a high risk when it comes to competitors, mainly because they have so many companies in their market that are similar sizes. For Johnson & Johnson, in comparison, has a moderate risk of competition. They do have 6 main competitors of similar sizes, which are companies like Estee Lauder, Unilever, and so on. The difference between these competitors and Comcast competitors is that the industry of Johnson & Johnson, they're not really competing with price, but rather stability with like regulations imposed by the government. Johnson & Johnson can minimize this risk by continuing to diversify and perform many mergers and acquisitions. The third force is threat of suppliers. As we mentioned in our other presentation, Comcast has a relatively low risk due to the nature of the suppliers, and it's the only way they can really get their content out there. Johnson & Johnson also has a low risk with suppliers. A supplier for them would be people that get their raw materials. The reason why they aren't really a risk is because they have to be careful about who they do business with to ensure the quality of their products. So they only really get their raw materials from suppliers that they trust and have done business with for years. They also have the protection of contracts to make sure that their suppliers can't do anything weird. And with how well-known Johnson & Johnson is, many suppliers would not want to risk their reputation by messing with them. They can continue to keep this risk low by continuing to do their due diligence and updating contracts. The fourth force is the threat of new entrants. Comcast, as we mentioned before, has a low risk of this. This is just because of their economies of scale. It's difficult to achieve in the telecommunications industry. Johnson & Johnson also have a low risk of threat with this one because they have really high capital requirements and capital expenditures in this industry. This industry would be really hard for newcomers because the nature of the market, there's 7 key players that have several different brands that produce the same products, so between them they kind of rule the market. However, the risk could potentially go up if innovation stops. This would allow them to gain competitive advantage through new and better inventions in the industry. So to make sure that happens, Johnson & Johnson should keep innovating. The last force is the threat of buyers. As we mentioned earlier, Comcast risk is very high. There's countless of options for people to choose from. Johnson & Johnson, on the other hand, have a low risk. This is because they're not necessarily selling straight to the customer. They go through a wholesaler or retailers that primarily stick to well-known companies such as Johnson & Johnson. This company also is backed up by like doctors and pharmacists that helps them to get a good reputation with buyers. They do run into a problem with the fact that switching costs are low, but with how well their name is, they have a pretty loyal customer base. And as far as strategy goes for both companies, they both use a mixture of cost leadership and differentiation, although I would say Comcast definitely leads with cost leadership. The reason we think this is because the largest group of customers in their market are middle class. In order to appeal to this target, they have to keep their services affordable and easy to access. Also, one of their main strategies is to offer discounts and coupons to gain brand popularity. Johnson & Johnson, I would say, leads more with a differentiation strategy. The reason we chose this as their main strategy was because the industry of medicine is pretty broad and allows them to expand into markets that are related to the line of medicine. For example, they recently entered the market of vaccines.
Okay, so next we're going to look at accounting policy data. So first we're going to look at revenue recognition policy. Both Comcast and Johnson & Johnson use performance policy, which basically means that once the customer receives their product or service, that's when they put down revenue for those products. And then for inventory evaluation methods, we couldn't find the information for Comcast, but Johnson & Johnson is last in, first out. And the reason it's important to know these methods is it helps the stakeholders to know how they're going to record, the company's going to record their revenue and expenses over time. And then for allowance for bad debt, Comcast for 2019 had a 3.6% allowance, which is in comparison to their competitor Disney, which had 2.2% allowance. Johnson & Johnson in 2019 had a 1.6% allowance, while their competitor Merck had a 1.3% allowance. For 2019, off-balance sheet obligations for Comcast, there weren't any, but for Johnson & Johnson, they currently have $50,381. So first we're going to look at return on equity. Basically, this ratio tells us how effectively management is able to use their assets to create a return for the company and also for stakeholders. So basically for Comcast, it has a pretty similar structure to the industry, but it is higher, while Johnson & Johnson is also higher than their industry, and this could potentially mean that they have just more equity than the industry. And then for operating return on equity, the only difference with this is that operating return is before they account for expenses. So for Johnson & Johnson, there is a difference between this one and return on equity, and that might be because expense does have a big part in how much is taken away from their revenue. And then return on assets. So this also shows how effectively management is using assets to make profit. The only difference is that it doesn't account for debt. So these also have pretty similar trends as well that are similar to return on equity. And then operating return on assets, this is the same thing as operating return on equity. It just basically shows how much they're making before the expenses taken into account. So the trend is different here than from the return on assets, which again shows that expense does have a factor on how much they're able to make. And then for gross profit margin, so this margin shows us how financially healthy the company is and how much they're able to make from the goods that they're making. And so they're pretty similar to their industry averages, which is a good thing, but could also maybe mean that they could take a little bit more risk to make more profit than the average. And then for liabilities to equity ratio, this tells us how much leverage the company is using. So both here, they are both increasing over time. I wasn't able to find the industry averages for these ones, but because they are increasing, this might mean that the company is selling off more equity.
All right, so I'm going to go ahead and start on the EPS analysis for Comcast. Just really quick, earnings per share is calculated by dividing the profit by the total number of shares outstanding. You can calculate basic EPS where you just take total numbers of shares outstanding, or you can use diluted from one of the financial websites where they dilute the number of shares to the number of possible outstanding shares, which is what I used. And this is just a strong indicator of profitability. And so I wasn't able to find the exact industry average for the telecommunications industry, so I just included some of Comcast's top competitors, Dish and AT&T. And one thing that's really noticeable here is you can see that Comcast started very low in 2006 and has steadily increased to match AT&T. And then moving into 2019, they actually surpassed them as there was that small drop in 2018. For Johnson & Johnson, we saw a peak at $5.93, which was incredible. Although Novartis did peak a bit higher, Johnson & Johnson has been consistently higher as time's gone on. So in 2019, they ended above competitors, and they're looking like a great investment so far as they continue to stay above their competition. PE ratio analysis, you can kind of see that Comcast has been all over the place as well as the rest of the industry. But near the end of this graph, you can see that they're all kind of leveling out near each other. And the PE ratio is a good measure of demand for the stock. It can also tell you whether a stock's like overpriced or underpriced. And currently, Comcast is listed as undervalued on Yahoo Finance due to their low PE ratio. As far as Johnson & Johnson goes, they saw a crazy spike in 2018, along with a very low EPS, which indicated the stock was overpriced and expected to fall. Other than that quick, really big spike, they've been level with their competitors and stayed fairly consistent as time has gone on.
So as we look at Comcast share price over the past 5 years, we can see a general uptrend. March 27, 2015, it was trading at $27.90 a share. February 7th of this year, it was trading at $44.74 a share, right before the global economic crisis. March 27th of this year, it was trading at $34.57 a share. So this is a 23.9% total increase over the past 5 years, and a 65.2% increase before the global economic decline. The share price drop in January of 2018 was due to increased interest in streaming services like Netflix and Hulu, and also the fear of people canceling cable services. They had a market cap of $157.39 billion as of March 27th of this year. And as opposed to Comcast, Comcast's main competitor, Dish Network, we see a general decline in share price over the past 5 years. It was trading at $70.63 a share March 27th, 5 years ago, and $20.98 a share March 27th of this year. That's a 70.3% total decline over the past 5 years. We see a share price plummet in late 2017. This is also due to increased interest in streaming services like Netflix and Hulu and Comcast competitive products. They had a market cap of $10.97 billion as of March of this year, which is significantly smaller than Comcast. It's $146.42 billion less than Comcast as of this year. So Johnson & Johnson's share price in March of 2015 was $134 a share. February 7th, it was $151.89 a share. March 27th of this year, it was $123.16 a share. It's a 22.7% increase in share price over the past 5 years, and a 51.4% increase before the global economic crisis. There's generally been good, consistent growth in the share price over the past 5 years. And they had a market cap of $324.69 billion as of March of this year, which is pretty impressive. And Johnson & Johnson's main competitor, Procter & Gamble, we see a 33.8% increase in share price over the past 5 years, and a 53.2% increase before the crisis. They had a drop in early 2018, and then it increased exponentially until late February of this year. They had a market cap of $272.06 billion as of March of this year. And J&J's share price was $12.99 higher than P&G on March of this year, as well as a higher market cap of $52.6 billion.
Okay, so for the executive compensation for Johnson & Johnson, we found that their CEO, Alex Gorsky, received about $20 million in total compensation for the 2018 year. About 72% of it was in equity, while 25% of it was in cash. We decided to compare it with their competitor, Procter & Gamble, and we found that their CEO, David Taylor, made about $17 million in the same year, with about 74% in equity and 24% in cash. So they were pretty similar, besides the fact that Johnson & Johnson's CEO earned about $3 million more. For the executive compensation for Comcast, we found that their CEO, Brian Roberts, received about $30 million in total compensation for the 2018 year. About 36% of it was equity, while 45% of it was cash. We compared it with one of their competitors, Verizon, and we found that their CEO, Hans Vestberg, made about $22 million in the same year, with about 75% in equity and 22% in cash. So it was pretty similar to the Johnson & Johnson situation, where they were compensated more than their competitors. A difference that stuck out was that Comcast CEO received more money in cash than equity compared to their competition at Verizon.
To forecast their income statement for the next 5 years, we have looked at both Comcast and Johnson & Johnson's financial statements and 10-Ks to gain more information about the companies. First, let's take a look at Comcast's income statement. As we can see, the company's revenue as well as the operating income has increased from 2017 to 2019. Income before income taxes decreased from 2017 to 2018, but then increased from 2018 to 2019. Operating income and income before income taxes as a percentage of revenue decreased from 2017 to 2018, and then from 2018 to 2019. Because of the current COVID-19 situation, we had to rethink about how the company will do in the upcoming years. As well as many other companies, Comcast is impacted by the virus. Comcast executives released a press release where they announced that they will help Americans to stay connected to the internet by the following ways. Next. So they released new policies for the next 60 days, which state that Xfinity Wi-Fi is going to be free for everyone. They're pausing data plans, and there won't be any disconnects or late fees charged to the customers, but only if customers contact them and let them know that they can pay their bills. And then additionally, Internet Essentials are going to be free for new customers. For this reason, we assume 2020 will have a decrease in revenue. We looked at how revenues have been growing historically, and then we took a CAGR of the growth from the last 5 years and used it as a base projection for the next 5 years. Since we don't know how long the situation will remain, we assume that Comcast will resume normal operations after 2020. We felt that this is accurate because Comcast is a large and stable company, and for this reason, we didn't see them growing too much, but also didn't see their growing slow down. Next. Now let's take a look at Johnson & Johnson's income statement. So as we can see, sales to customers and operating earnings have increased. The earnings before provision for taxes and on income and net earnings have increased from 2017 to 2018, but then decreased from 2018 to 2019. Operating earnings as a percentage of sales to customers increased from 2017 to 2018, but then slightly decreased from 2018 to 2019. However, it hasn't reached the 2017 level. The earnings before provision for taxes on income as a percentage of sales to customers have decreased as well. The net earnings as a percentage of sales to customers increased from 2017 to 2018, but then we can see a slight decrease from 2018 to 2019. Because Johnson & Johnson is in the health industry, COVID-19 has not affected the company as it did with Comcast. Johnson & Johnson sells necessary health items to people, so people will keep buying them and the company will keep up with its sales. Therefore, we took a CAGR of the growth from the last 5 years and used it as a base projection for the next 5 years.
So what we did was we took our forecasted revenue for Johnson & Johnson and Comcast, and then we went ahead and took the outstanding shares that they had in 2019. So that with the forecasted income of $12,682,000, that gave us a forecasted EPS of $2.79 per share. And as you can see, it's kind of gone consecutively up over the last 5 years. It did peak in 2017 and then dropped again in 2018, and we're seeing that slight increase again. And then with Johnson & Johnson, we have the same type of situation. It stayed pretty consistent, and then 2020, we do expect it to go down a little bit. They did have 2.64 billion shares outstanding last year, and the net income was a little bit lower than that of 2019. And so that's why there's that little bit of a decrease between 2019 and 2020.
All right, so we made the decision of choosing Johnson & Johnson over Comcast for if we were going to invest into a company. One of those driving factors that led to that decision was the earnings per share. I mean, Johnson & Johnson is at $5.63 EPS right now, and Comcast is at 2.83. Another thing is Johnson & Johnson has a lower beta at 0.66, while Comcast has a 1.0. Comcast is looking a little bit riskier in our eyes, and we're in it for the long haul. So investing in Johnson & Johnson seems to be the right decision with the lower risk factors. Johnson & Johnson has a relatively lower risk in our 5 forces analysis. As you can see, the only real high risk is competition, whereas Comcast has a high threat of buyers, competition, and substitutes. And things are just trending up for Johnson & Johnson, while Comcast has just seen a downturn with this economic crisis. Although some people may say Johnson & Johnson stock price is overvalued currently and Comcast is undervalued, and therefore you could potentially make more money with Comcast, we see Johnson & Johnson expanding into adjacent markets in the near future, and we think that they will, in the end, generate more revenue if you were to invest in that company.